My name is Michelle Loy. I'm the Executive Director of the Financial Management Association, and I want to thank everybody for joining us today. This is our first seminar of the Fall 2024 seminar series of the Research Seminars in Finance, Economics, and Banking. We call it RSI FEB. FMA is very pleased to partner with the Finance, Economics, and Banking Research Network, FEB-RN, to host a series of virtual seminars featuring researchers who are at the forefront of their fields. And today, of course, is a fabulous example of that with Professor Stulz of Ohio State. Today, he's going to be talking about a research topic that I've seen a lot on our recent conferences, startups, and why startups become unicorns instead of going public. Today's moderator is Cesario Mateus, and I'm going to go ahead and boot it over to him after just one housekeeping note. If we do have any questions, and I hope we have a lot of questions during today's seminar, please go ahead and drop them in the Q&A module. If you are on a laptop, it's on the bottom of your screen. If you're on a mobile device, it's somewhere around the perimeter. But please drop them in throughout the seminar, and we will address them at the end of today's presentation. With Cesario, I'm going to go ahead and post that to you.
Okay, thank you. Thank you very much, Michelle. I welcome you all to another FEB-RN FMA International Research Seminar. As you well know, FEB-RN is a no-profit research collaboration of scholars established through an extensive network of 23 international universities. You can have all this information in FEB-RN LinkedIn page. It is my great pleasure today to introduce our speaker, Professor René Stulz. Professor Stulz is the Everett Degrees Chair of Banking and Monetary Economics and the Director of the Dice Center for Research in Financial Economics at The Ohio State University. He is a past president of the American Finance Association and the Western Finance Association, and a fellow of the American Finance Association, the Financial Management Association, and the Wharton Financial Institution Center. He was also editor of the Journal of Finance for 12 years and co-editor of the Journal of Financial Economics for 5 years. He has published more than 100 papers in finance and economics, including the Journal of Political Economy, the Quarterly Journal of Economics, the Journal of Finance, Journal of Finance and Economics. Well, almost these 100 papers published in the top journals in finance and economics. So I'm not going to take more time because all our attendees, they are looking forward for the presentation. So without further ado, Professor Stulz, on behalf of FEB-RN and FMA International, and our attendees and participants in today's seminar, thank you very much for accepting our invitation, and we are looking forward for your presentation.
Thank you, Michelle, and thank you, Cesario. It's really a treat to be giving a global seminar. I have never done that. So depending on where you are, good morning or good afternoon or good evening. I'm going to talk about my paper on why do startups become unicorns instead of going public. It's a paper with Daria Davidova from EPFL in Switzerland, Rudiger Fallenbrach from EPFL as well, and Leandro Sanz, who is from Notre Dame in the US. So the paper is about a puzzle. To set the stage, now a unicorn is a firm with a post-money, so after the fundraising, headline valuation of at least 1 billion. At the end of the sample periods that we have in the paper in 2021, there were 427 active US unicorns. The unicorn phenomenon is a global phenomenon, but we study it using US data, and we believe that what we say about US unicorns applies globally. The puzzle is that unicorns could be public firms if they wanted, but they choose to remain private. So our paper is focused on the question, why would the unicorns rather be private firms than public firms? The unicorn phenomenon is a 21st century global phenomenon. Before the 2000s, large firms of unicorn size went public rather than raise funds at a post-money headline valuation of $1 billion or more. For instance, in the US, the median tech IPO market cap in 2017 dollars is below 204 million every year before 1998. So the median market cap for IPOs was a fifth of the 1 billion that is the minimum for a unicorn. I said it's a global phenomenon. In March 2024, there were 1,229 active unicorns in the world. So about 3 times the number in the US, and valued at 3.8 trillion in total. So there are potential explanations for the unicorn phenomenon. And kind of the most common one is just that there has been a tremendous increase in funding available for private firms. And so this increase could explain why firms stay private longer. And as firms stay private longer, some will eventually grow to be unicorns. So that's a straightforward explanation. And then once the firms become unicorns, they have access to new sources of funding, which allows them to stay private even longer. However, for firms with funding to stay private as unicorns, they must be better off doing so. It is not enough for them to have the funding to stay private. Consequently, a theory for why firms choose to become unicorns rather than go public must explain why the fraction of startups becoming unicorns differs dramatically across industries. Let me give you an example to which I will come back. In our sample period, healthcare in the US has 28% of the startups, so an extremely large fraction, but has only 11% of unicorns. So this tells you that healthcare startups are not that likely to become unicorns. There are other industries where startups are much more likely to become unicorns, and we'll talk about that. So why stay private? What could be the advantage of staying private? We are going to focus on the emergence of a new type of firm. And this new type of firm is a type of firm that has a lot of intangible assets. If you look at the public firms in the US and worldwide, you see a dramatic growth in intangible assets for firms. There are 2 types of intangible assets. There is R&D and there is organization capital. The new type of firms relies heavily on organization capital. Evanson and Westphal defines that capital as a knowledge used to combine human skills and physical capital into systems for producing and delivering products. The new type of firm has a business model that relies on economies of scale and scope, on network effects. It obtains these economies of scale and scope on these network effects through investment in organization capital. For that type of firm, we argue that going public is costly if the firm is not sufficiently established to defend its organization capital and to reach scale. It is very vulnerable to competition because you can simply copy the ideas of that firm concerning its business model if it relies on organization capital. You couldn't simply copy what a firm is doing in R&D because with R&D, it can use patents. You really can't use patents for organization capital. So this type of firm has considerable value if it succeeds in reaching scale, but not if it fails to do so. An IPO could delay reaching scale before the arrival of competition, which would destroy value. Being public could also make it harder to reach scale because you have more attention, more distraction of management, more regulatory constraints, among other things. So we have some testable predictions that firms that invest in organization capital with a business model that relies on scale and network effects will stay private longer to protect the building of their organization capital and reach scale. Firms that invest mostly in R&D do not have to be large to protect their intangible assets because they have patents. We expect unicorns to be firms that invest heavily in organization intangible assets relative to R&D. We expect unicorns to be firms whose value depends heavily on reaching scale and achieving network effects. To succeed, a unicorn requires funding, and will show that unicorn status makes it possible to attract new types of investors. What do we find? We find that indeed unicorns invest heavily in organization capital compared to other similar VC-funded firms. By similar, we mean VC-funded firms in the same year that have similar total funding, similar age, and similar post-money valuation as for the pre-unicorn round of the unicorn. Unicorns are more likely to have a business model that relies on achieving scale and network effects. We find that unicorn status gives access to new types of investors. And we find that unicorn status enables founders to postpone the IPO. In particular, a reason for that is that investors are willing to provide liquidity to founders, employees, and early investors. So the rest of the presentation, I will briefly talk about the history of unicorns. I will go to the funding benefits of being a unicorn. I will talk about which type of startups are likely to become unicorns. And I will talk about unicorns at exit. So the sample that we construct for this paper is a comprehensive sample of US unicorns. The first unicorn was in 2005. In our study, we look at 2010 to 2021, and we construct a sample of VC-funded firms that raised at least $50 million for comparison. For each unicorn and for each VC-funded firm in the sample, we have the full funding history. The total for our sample until the end of Q3 2021 is 639 unicorns. Here we have a figure that shows the birth of unicorns on the left and the unicorns exits on the right. And you see here that the growth of the unicorns takes place after the global financial crisis. And it picks up speed with 2021 being a rather unique year. You might be concerned that what I'm going to talk about is the result of 2021, but it's not. In the paper, everything we do, we also do dropping 2021, and the results are the same, the conclusions are the same. So some key statistics for unicorns. I will give you medians because there is a lot of skewness. From incorporation to unicorn status is 6.3 years. The typical headline, the median headline valuation post at the unicorn round is 1.2 billion. The post-money valuation in the last financing round for unicorns is 2 billion, last private financing round. The unicorns raised 253 million in the unicorn, up to the unicorn round, and they raised 352 million as a private company. In our sample, now out of the 600 and some unicorns in the sample, 212 exit, and that's a third of the sample. Exit before the end of our sample period. We have data in the paper for those that exit. I'm not going to give you all that data, but I will give you the kind of the main pieces of information that are useful for our discussion, for the presentation. The time from unicorn funding to exit is just over 3 years. We have 21 unicorns fail. We have 110 IPOs, 9 direct listings, 18 unicorns went public through a SPAC, and 44 were acquired. After our sample period, now we have 427 active unicorns at the end of the sample period. 15 of those exits through IPOs, 13 through SPACs, 16 through acquisitions, and 14 fail. So let's turn to funding availability. Before the 2000s, funding for private firms was much more limited. A number of events took place that increased the funding for private firms. One important event was kind of the deregulation for private firm funding, both for individual private firms as well as for funds. Another important event was the institutionalization of wealth management. Large institutional investors tend to invest differently from others. They value scale. They have large portfolios, so they want to make large investments. Investments in unicorns tend to be large investments. And so all this opens the door for new classes of investors who invest in high valuation private firms. For many of those investors, 1 billion is kind of the dividing line. If it's less, they don't invest. If it's more, they are interested and will look at it. And so that makes it attractive for founders to achieve this valuation if it's possible for them to do so. So founders value this unicorn status. Now it gives them access to more funding. It allows them to stay private longer. And you can see evidence of how they value that status in that plot, which gives you the frequency of deals for various amounts. And you can see that there's this enormous spike at exactly 1 billion headline valuation. And in our sample, more than 200 unicorns had a post-money headline valuation of exactly 1 billion. So clearly it is valued. So founders actually value unicorn status so much that they will grant special privileges to unicorn round investors, like some priority in the case of liquidation, some priority in the case of IPO, and so on, to get them to agree to the unicorn valuation. That doesn't mean that the unicorn round investors get a free lunch. They pay for what they get. But the pre-unicorn round investors do not have those benefits. And as a result, the price per share that unicorn investors agree to includes the benefit. The value of shares for pre-unicorn investors is less because it doesn't include those benefits. So when you compute the fair value of the startup, as opposed to the headline values that is circulated, the fair value is not the unicorn share price times the number of shares, but is less than that. There's a well-known paper by Gornal and Strebulev that has a model to compute the fair value of unicorns and to measure the value of these privileges. We use their paper to find the fair value for the unicorns in our sample. We were able to do that only for the unicorns that are also in their sample because we don't have their data for the other firms. But the plot here is very instructive. The black lines are the fair values. The gray lines are the post-money headline valuations. Now, the post-money headline valuations start at 1 billion, not surprisingly, because that's what that makes a unicorn. And you can see that the fair values tend to be to the left of 1 billion and less than 1 billion. With unicorns, access to investors differs from typical VC funders. Now, that's in part because of this institutionalization of investors that I talked about. It has already been shown that mutual funds invest in unicorns, but we show that this goes wider than that. That other large investors invest in mutual funds, in unicorns. And another important feature of the investors that come at the unicorn round is that they're often willing to provide liquidity to founders and employees so that the founders and the employees can sell some of their shares and don't have to wait until the IPO to indulge in expensive real estate, on expensive cars, or maybe an airplane. We do not have data on amount funded, but we have data on the investors. And so this table tells you the top 10 unicorn round investors that are not in Series B rounds for the firms in our sample. Okay, and you find on top Tiger Global Management, which is really a hedge fund. You find the SoftBank Group. You also find mutual funds. You can find growth funds. And Econic Capital is a little bit of a family office and a little bit of a growth fund. We look at, we use regressions to look at differences in the composition of investors. And so the dependent variable is the investor type. And then we look at the number of, for the first column would be angel investors in each round. And I show you the results for the unicorn round. And so what we have there is that angel investors are less likely to invest in unicorn rounds. The venture investors are much less likely to invest in unicorn rounds. But the asset management investors are much more likely, and the growth funds are much more likely to invest in the unicorn round. Now in the US, there are lots of venture firms in San Francisco. We also know from the literature that venture firms tend to invest close to home because it makes monitoring and interactions easier. And so what we find is a pretty dramatic difference between the location of pre-unicorn investors and the location of post-unicorn investors. The pre-unicorn investors are closer to the location of the unicorn and are closer to San Francisco. The post-unicorn investors are farther away from the location of the unicorn and from San Francisco than other round investors. In the paper, we discuss the liquidity provision. Now we looked at IPO prospectuses because that's kind of where you can get the data. And we list a number of cases. Now with DoorDash, that went public in December 2020. In 2018, the three of the executives were able to sell stocks in a liquidity event totaling 62 million. Lyft had a similar event. It's also interesting to know that the largest current unicorns, SpaceX being the largest in the US, tend to have liquidity events for their employees at every 6 months or so, which makes it, which kind of lessens the pressure to go public to provide liquidity to the people who have options. So to summarize, the unicorn around has more asset manager and growth investors, fewer venture investors. The distance of investors from the unicorn and from San Francisco increases after the unicorn, with and after the unicorn round, compared to what it was before. So now I turn to organization capital, scale, and network effects. We don't have firm level data for unicorns that do not go public, but we have data on young public firms across industries. We use that data from young public firms as a proxy for data for unicorns. So if startups become unicorns to build their intangible organization capital, as we discussed, we expect unicorns to be in industries where intangible organization capital is important. For industry classification, we use the 20 sectors of CB Insights, but reclassify startups according to their end product, and we explain the details in the paper. So what we find is that unicorns are really heavily concentrated in two sectors: business products and services, on the internet sector. These sectors have 44% of unicorns, but only 24% of startups. Healthcare, as I already mentioned, it goes the opposite. It has a lot of R&D. You can patent R&D, so you don't need to become big before going public. Healthcare has 11% of unicorns and 28% of startups. A whole bunch of industries have almost no unicorns. That's food and beverage, electronics, metal and mining, retail, agriculture, environment. We also measure the importance of scale and network effects for the unicorns and for the other startup firms in our sample. What we can do is CB Insights as business descriptions. And we look at those descriptions to see if they mention scale and network effects. And if they do, we use a value of 1 for scale. So we have an indicator variable. For instance, here we have Jasper Technologies, which is a unicorn in our data set. And it talks about using platforms. It talks about having a platform, talks about network affiliates, and so on. And so that one was qualified as 1 for scale. So when the dependent variable is whether a startup is a unicorn or not, now controlling for industry, we find that scale is important, that the ones that have this indicator variable at 1 are more likely to be unicorns. And we also find that the ones near San Francisco are more likely to be unicorns. When we look at the industry characteristics on the fraction of unicorns in an industry, we estimate panel regressions where the dependent variable is a fraction of unicorn per industry. And when we do that, now we focus on R&D for the reasons we already discussed. We need a proxy for investment in organization capital. The literature generally uses SG&A, which is sales and general administrative expenses, net of R&D. And so what we see on the right is there is a strong positive relationship between the frequency of unicorns in an industry if SG&A is higher, so a strong positive relation between SG&A and unicorn frequency, and an insignificant negative one for R&D on total assets. We talked about the importance of funding flows, and so we investigate this. The problem with funding flows is that there is an identification issue. Now, the funding flows could just reflect the good opportunities in the industry, as opposed to anything having to do with what we are talking about in terms of the benefit of flows. And so we need a measure of investment that is uncorrelated with the potential of industries. We use two instrumental variables. We use the closing of the first SoftBank Vision Fund in May 2017. That fund now had committed to investing in a subset of industries. And so we look at the industries where it committed to invest versus others. And we use an indicator variable for whether an industry is a target for the fund. We also use inflows into buyout funds over the last 4 quarters. So why does that make sense? Well, SoftBank surprised the market with a fund that was enormous in size. Now, at the time that they announced the industries, they didn't know that they would end up with the size that they did. That was a surprise. And so for our instrument to make sense, we need to maintain that SoftBank in early 2017 was not better able to predict the potential of industries than the remainder of the VC industry. We provide some support for that in the paper. When it comes to flows into private equity funds, now those flows are related to shifts in commitments to private markets broadly, but unrelated to VC commitments to specific industries. So here are our regressions. The first one is the OLS regression, and we see a positive relation with industry funding flows. These are regression control for industry characteristics. I've quarter fixed effects and use firm level clustering. The second column gives us a first stage regression, so the industry funding flows. And they are strongly related to this indicator variable for SoftBank. They're strongly related to flows into buyout funds. And then the third column gives you the instrumented coefficient on the log of industry funding flows, which is positive and significant. So the summary of key results supportive of the role of funding and organization capital. We saw that a VC funded firm is more likely to be a unicorn if investment in organization capital in an industry is high, if scale is important, if industry private funding flows to the sector are high, if distance to San Francisco is low. A VC funded firm is less likely to be a unicorn if R&D is high. We then created a match sample to compare startups that become unicorns to startups that do not. For that purpose, we match unicorns to venture-funded startups as follows. We match a startup that raises funds in the same year as the unicorn last pre-unicorn fundraising round at similar valuation, raised a similar total amount as the unicorn up to that point, and a similar age at that fundraising as a unicorn. So when we do that, we find that we match closely, that scale is more important for unicorns. Unicorns raise a large amount of funds post last pre-unicorn round compared to venture funds at that round. Unicorns are less likely to exit and less likely to exit through acquisition, and they're closer to San Francisco. We then restrict the sample to the unicorns that IPO on to the matching startups that IPO. Now that gives us a sample of almost 100 observations. The key point that we get from this table is that the unicorns have much more investment in SG&A. So I should make clear, the data that we have here comes from the IPO prospectus. And in the US, in the IPO prospectus, you have to report data for the 2 years before the IPO. So this is what those firms did 2 years, the year before the IPO. And we see that SG&A is much higher for unicorns, as we predict. And we find that R&D is much lower. And the differences are significant. We also estimate regressions, and we still get the same results with regressions where we control for all firm characteristics. Lastly, we look at the importance of patents for unicorns. We argued that unicorns invest in intangible capital investment that is not easily patentable, and so it's different from R&D investment. So we expect patents to be less important for unicorns than other startups. So we look at patents over total funding using the match sample of unicorns and startups at IPO. And things look like this. Now on the axis, we have the median cumulative patents. So that drops at the IPO because of the funds raised. But what you see is that unicorns, the line for unicorns, which is a dark line, it's much lower than the line for the other startups, as we would predict. So conclusion. Now, why do startups become unicorns rather than go public? That's a puzzle that we try to understand. And now before 2000, the startups would have had an IPO and not reached unicorn status. And so why did founders decide to stay private and become that big? And our answer is that firms that rely heavily on organization capital and much achieve scale network effects to be highly valuable are better off staying private until the assets are sufficiently developed. And unicorn status enables firms to stay private by attracting new types of investors. Thank you for your attention, and I look forward to the questions. Thank you very much.
Thank you, Professor Stulz. We have now time to some questions and comments, so feel free to use the chat button as Michelle indicated, and I will pass the questions as time allows to Professor Stulz. Nevertheless, if we don't have enough time to cover all of your questions or comments, we'll pass by email later after the seminar. I will start by saying that in your paper with your co-authors, you propose an efficiency explanation for the existence of unicorns. This efficiency reason is that going public can be especially costly for firms in the early stage of building organization capital. And as a result, firms relying highly on organizational capital maximize their value by staying private. So that follows your presentation. The question is, or what is your opinion of how this efficiency explanation relates to the fact that shareholders, investors perceive firms with high levels of organizational capital as riskier than those with more physical capital. Therefore, there is a unique risk associated with the intangible and firm-specific nature of organizational capital. Would this unique risk contribute to these firms to stay private, or is the efficient explanation per se is the main driver of them to not go public and they stay private? What is your opinion? Are they somehow related or not in terms of the riskiness of these firms with a highly organization capital, or is just from the side of the firm that they think is better to postpone, if that's the case, going public?
This is a fantastic question, and it highlights that our paper could be better on discussing this. And so it's a great question because we're working on our vision of the paper, and we are going to talk more about that. Now, investing in intangible capital creates agency problems that you don't have if you invest in physical capital. Now, if you say we are going to build a plant, people can look at the plant, can touch it, and know that it's being built, at least most of the time. If you say that you are kind of putting together a method to do something that is going to be highly valuable, it's a lot harder to touch that and to see it, to understand it. And the problem is, by talking about it in public at a level of details that may make it credible, also makes it available to your competitors. And so the question is, how can you kind of address this agency problem that, no, I mean, you might be saying, well, gee, we have these fantastic technologies that we are building. Now we have 1,000 software engineers that allow us to do that. How do you know that it's actually going on, that it's going to work, and so on? Now, if you are private, you have shareholders to whom you can give that information. You have few shareholders. If you are public, no, you don't give it to the shareholders, you give it to the world. No, and so this agency problem is an important one, and is part of the reason why it's beneficial to be public. Now, I mean, it's not that the public markets don't recognize the value of organization capital. Now, think Apple. Well, the tangible assets of Apple are quite small. No, its equity capitalization is like 3 trillion. The tangible assets are maybe 300, I mean, balance sheet is 300 or 400 million. Apple gets full credit for its intangible assets, or at least close to full credit, or maybe too much. I mean, but now the market recognizes that value. It's very different to recognize that value if you're a startup. No, I mean, if you're Apple as a startup saying we are going to have this incredible supply chain, give me $1 billion so that we can start building it, is a very different story.
Absolutely.
So great question.
Thank you. There is one of our participants, Andrea Poiser, that put 2 questions. So if you allow me, I'll pass the 2 in once because they are very short. One is related, do unicorns make use of patents as a competitive strategy? And what are the determinants of unicorn status? What is driving the valuation? So is regarding if they use patents as a competitive strategy or not, if there is evidence that they use it, and what determines this unicorn status, which is a very broad question.
Right. No, I mean, it's a good question. I don't think I can do it justice. So I didn't have time to talk about this thing that we have, this analysis we have in the paper. In the paper, we look at a decision by the US Supreme Court called the Alice decision. And that made it much harder to patent software like innovations. And so it goes to our points that you can't really patent very well kind of organization capital. I mean, what Apple can't patent its supply chain, no, I mean, or the way it built, I mean, it maintains and builds its supply chain. And so I don't think it's strategic for them to have fewer patents as we demonstrate. It's just you can't do it. And so the inability to, I mean, now at this point, I mean, nobody in the world would say, well, gee, I mean, we are going to compete with Apple and we are going to have the same supply chain. No, I mean, so at this point, no, it's not like somebody is going to be able to copy Apple and beat Apple. That doesn't make a lot of sense for the supply chain. No, I mean, and so once you are public, once you are established, there are lots of things you don't have to worry about. There are lots of things you have to worry about that you don't have to worry about when you're private. No, and so being private can be very valuable at the stage where you haven't reached scale, you haven't reached kind of the network effects that you are seeking. It may not be as valuable once you have done that.
Thank you. Thank you very much. We have a question from Jesus Salas, and he is asking, is liquidity provision to founders more common for unicorns than in firms that go public without ever becoming unicorns? Do you have some information, some evidence in terms of if there are differences between, or if it's more common to unicorns than firms that go public without ever becoming unicorns?
I mean, this is a great question. I mean, so now the difficulty with paper on this is that we really couldn't do a systematic search. Now, my understanding and our understanding is that VCs are extremely reluctant to provide liquidity to founders before the firm goes public. Now, the traditional VC model is you fund the firm, you bring it to public, and that's a liquidity event, and the founders can cash in, and the VC, I mean, eventually cashes in. And then the VC goes on and does something else. So in that sense, having a different type of investor is key to get this, this liquidity. No, so having new investors coming in, as they come in, those new investors may be willing to buy shares or maybe eager to buy shares from the existing VCs and the founders to be able to participate in the opportunities brought about by that firm. And so it's a different way of thinking, because VCs would typically be concerned about kind of the agency problem. No, I mean, if the founders are able to cash in to some extent, maybe the incentives will be different, or maybe it just reveals something about what they believe is the true value of the startups. No, and so, but it would be really nice to be able to do that systematically. That may be some things that will be added to the paper. But no, the paper is already long as is, so we'll have to think about it.
Just thank you very much, Professor Stulz. Some participants ask for the paper. I will circulate, if Professor Stulz will give authorization to the attendees, the last version that you kindly share with me, because there is one attendee that said that he only get the version from 2023, I believe, and there is a more recent version. I will circulate the paper. There is a question from two participants that or two questions, but they can be merged. Is regarding your data, if it's possible to identify firms that have chosen to become public rather than becoming a unicorn, and if it's a yes, so the objective of the goal of the question is to understand if the effect is coming from the supply side, the source of capital, or the demand side, the cost of becoming a public firm. And another part is that if you can clarify further what is the source of data, because if you say what is the source of your data in the paper, which is written, but they didn't get the access to the paper.
Okay. Now we maybe I can. Oh, I guess I can't. I can share it with you, but no, the. So what we do in the paper, no, we do the comparison that is asked in the question, in the sense that we have a sample of startups that do not end up as unicorns, and so what we end up, and so you can think of our data set as really all the startups that get at least 50 million of funding, and we follow them through time. And when you think of that, there's really no selection bias in what we are doing in terms of comparison, because we have all the startups that start with 50 million, and we look at them at a round, which is not the last round before becoming unicorn for the unicorns, but we match that to a round. I mean, the same round for the comparison firms, and so with that, we are able to figure out the differences between the startups that become unicorns and the one that don't. But no, I mean, I think that the limitations of what we do is kind of what generates the question, because we are not able to look at the performance of those firms. And so we are not able to look at whether the match firm doesn't IPO. I mean, IPOs faster because it can't raise funds in the private sector. No, I mean, privately. No, so that would be an interesting question to look at. Does it go public because it can't become a unicorn, or does it become public because it has attributes that don't make it worthwhile for it to become a unicorn? Okay, what we show in the paper is that it certainly has attributes that make it less likely that it will become a unicorn. No, so on average, the firms that don't become unicorns differ from the one that do become unicorns with respect to investment in organization capital, with respect to R&D investment, and with respect to the importance of scale. The data set from which we construct the sample of startups is from CB Insights.
Okay, thank you. Thank you very much. One of our participants, Ronald Kumar, asked if there are any regulatory constraints. And I think that to some extent you discussed that in the paper. If there are any regulatory constraints that could also restrict unicorn to become public, as making unicorn continue as private. So is there any regulatory constraints that could avoid or making more likely them to continue private instead of going public during
So
the time period?
there are lots of regulatory issues, and that's a very good point. And we talk about some of them in the paper. Now, for a long time in the US, the number of shareholders was kind of determined whether you went public. If the number of shareholders initially was 250s and 500s and 1,000, exceeded the number, you had no choice, you had to go public. But deregulation in the US has kind of made that irrelevant. Now, Facebook went public because it had too many shareholders. And a tricky issue for firms was that now if employees exercised options, then they became formally shareholders. And so if you had a lot of employees getting options, you ended up with a lot of shareholders. Their regulation led to a situation where shares held by employees don't count towards that number. And that number also got increased and is calculated in such a way that it's not binding. Now, the US, and I said, well, what we find for the US applies globally. But now that there are obviously idiosyncrasies of the US. Now in the US, corporate law is state law. But there are some federal laws that impose regulations on publicly traded firms that are not imposed on privately traded firms because they are not that they are not subject to federal laws, they're subject to state law for corporations. Now, so if you think of the US had this legislation called Dodd-Frank, which kind of revised the financial system. But that legislation also had some stuff on corporate governance, but it applied only to the public firms. Now, so there are a bunch of laws in the US that have implications for what public firms do, but the private firms are left alone. And so now the public firms have to report to the SEC. They have to report on their situation regularly. Private firms don't have to do that. Now, and so there are differences. And now in the paper, we talk about the fact that those differences make it more valuable to be private, again, until at least you reach some threshold. So they are important. And I mean, in other countries, you have differences between public and private, but they are especially stark in the US.
Thank you. Thank you. I think that we still have time, if you allow me, for a last question. And of course, there are so many of them, and then we forward to you. And the question is from Joseph Ziadi, which he asks, do investor involvement in unicorn differ from involvement in IPO, which might be one of explanation why performance differ? For example, board representation, strategic support, etc.
So I didn't quite get the beginning of the question. Is it?
So what is asked, Joseph, is that do investors' involvement in unicorn differ from involvement in IPO?
Good point. No, I mean, that goes back to this issue of agency problems that I talked about. Now, when you are private, you have few investors. Those investors have a large stake. So, I mean, I have lots of incentives to be closely involved. They are generally closely involved. And now that's a benefit of being private, which is that you can communicate with the shareholders easily. You don't have to worry about disclosure laws. Now, in the US, once you are public, now you can't go and reveal details about what you're doing to a large shareholder. You have to make it public. But when you are private, now you can take your 3 shareholders in a room and tell them, well, here is exactly what we are doing. And you don't have to worry, at least not too much. So there are clearly differences in investor involvement. And now those are important in our story.
Thank you. Thank you very much. It's 10 a.m. So it's time to finish. We had more than 20 questions and comments, so I was only able to pass a few of them, but we'll share all of them with you by the end of the seminar. And on behalf of FEBRAN and all the universities that organize these seminars in partnership and with the great contribution of FMA International, I just want to say thank you very much for being with us and being today with us and to share your paper and knowledge with all of us. Thank you very much. Michelle, you are muted.
Very sorry. Let me echo Cesario's thanks to you for clearly a very, very interesting paper that offers a lot of discussion. Three things that I want to mention. First, the August 2024 version of this paper is on SSRN, and I dropped that URL in the chat. So if you can't find it, look there. But that's readily accessible. We have questions about whether this presentation and also the slides are going to become available. We are recording this, but this is subject to review by Professor Stulz. With approval, then we will go ahead and post that onto FMA's YouTube page. Last but not least, this is not the last you will see of Professor Stulz in the next month or so. He will be speaking at the FMA annual meeting, giving an overview and research idea sessions on the public and private markets. So please join us in Texas for that. He will be speaking on Friday, October 18th in Grapevine, Dallas, Texas. So please join us for that. Last but not least, this might be point number 4, but who's counting? I hope that you all will join us for our next seminar in this series with Karen Thorburn on October 3rd, 2024. Look out for information on that in your email. It's also already on the website. But again, thank you so much for this great talk today. Clearly, lots of questions, lots of discussion that you are generating. And we will pass on any unanswered questions to you after this.
Well, thanks, Cesario and Michelle, for giving me this wonderful opportunity. And thanks the audience for listening to me.